Hi, good evening, everyone. Thank you for taking your Thursday evening to come join us for our Meet Syfe session. Tonight, we have Sebastian, our head of distribution. They'll be giving us an introduction to who we are, what we do in our investment framework. Over to you, Sebastian.
Great, thanks Hayden. Good evening everyone. Welcome to our Meet Syfe session. It's supposed to provide an overview of all the investment portfolios we offer, as well as an introduction to us as a company. There is a Q&A tab at the bottom of your screen usually, which you can use to ask questions, and we will make sure to take some breaks to answer as many of them as possible. That said, let's get started. Very quick an introduction about the history and the team. So Syfe was incorporated by now more than 3 years ago. But in July 2019 is when we became publicly available. So when we got the CMS license for fund management granted by the MAS, we launched with our first portfolio. Throughout these 18 months, we have been started to offer wealth expert service where people can reach out and discuss their individual circumstances. And we have launched a whole range of products, from a Cash Plus solution, which is a cash management tool, to a set of other portfolios. A very popular, the REIT Plus portfolio, the Equity 100 portfolio, or also the Syfe Core portfolios. On the right-hand side, you can see part of the leadership team. So there is Dhruv, the founder and CEO, as well as Richard, our head of portfolio construction. Richard will do a session actually next week, more of a deep dive into our investment strategy, while today we will more give an overview. And so the background of the team, which actually by now is not anymore 40 plus, but more like around 60 people, is really very different. It comes from a lot of course, finance companies like the UBS and Goldman Sachs and Citi, but also like technology companies, which really bring the technological aspect of the business and experience into the company. We are, as I already mentioned, licensed by the Monetary Authority of Singapore. We are a Singapore-based and headquartered company. We have a retail fund management license, meaning we are able to take funds from retail clients and are not limited to either accredited investors or institutional investors. That means we need to fulfill very stringent requirements set by the MAS, more stringent than if you are working under a financial advisor license, or if you are working with a CMS license, which is limited to accredited investors. Furthermore, the funds of Syfe as a company, as well as the funds of clients, are always segregated. So the client funds go into a DBS trust account, and from there they're invested through our broker, Saxo Capital Markets. The securities are then custodized by Citibank and HSBC. With that said, we go right into what is our portfolio offering. We currently have 4 key portfolios. As I mentioned, and we go into a bit more detail later on, I want to just first provide a bit of an overview. We have the Cash Plus portfolio, which is a cash management solution. So this should really be the place where you can park savings, which you might not need for a month or a couple of months, and you can achieve a higher return than the interest you would earn on your bank account. So this is the lowest risk portfolio we have in our offering. It invests into a fully bond in a full bond portfolio, and currently achieves a projected return of 1.75% per annum. Highly popular is our REIT Plus portfolio, which is a Singapore dollar denominated portfolio for passive income as well as growth. It tracks the S-REIT Leaders index by SGX and is very attractive because of the high dividend yield. You have two options. I will share more about them later on. The core portfolios is a set of 3 different portfolios, from defensive to balanced to growth. It's all about a risk-adjusted return maximization. So it's a mix of equities, bonds, and gold combined in a way to maximize the risk-adjusted returns. It has exposure globally, but it also includes China and Chinese tech companies. The approach we use is an asset class risk budgeting, and we go in a few more details on this later on. If you're looking for a high growth portfolio, then the Equity 100 might be a good choice for you. It's, as the name suggests, 100% equities portfolio, and it provides you access to about 1,500 stocks of the world's best companies, including names like Google and Amazon, Tencent, Alibaba, and so on. It applies a smart beta strategy to maximize returns. And again, on this, we'll get a bit more detail later on. As I mentioned earlier, for a deep dive into the different investment strategies, I highly recommend the webinar happening next week together with Richard Ye, our head of portfolio construction. All right, so let's jump right into it. Syfe Cash Plus. What is this all about? Some of the highlights all in one page. We aim for a projected return of 1.75% per annum. The returns are accrued on a daily basis. That means on a daily basis, you will see the value of your portfolio change. It's very easy to actually transfer funds between different portfolios. And soon, I think as early as kind of end of next week, if I'm not mistaken, you will be able to set up automatic recurring transfers. So you can transfer a lump sum into your Cash Plus portfolio and then set up recurring transfer, which transfers a certain amount into your REIT Plus core or Equity 100 portfolio at a frequent recurrence. There's no minimum investment amount. You can put as little as $1 and as much as you want. And there is no lockup period. So unlike a fixed deposit, where your funds are locked up for a given period of time, these funds are available at any time, and withdrawing and depositing only takes about 2 days. And also these withdrawals, they don't cost anything. So there's an unlimited number of free withdrawals. So what's actually in this portfolio? How do you earn this 1.75% projected return? The portfolio consists of 3 different funds. They're all issued by Lion Global, and it's the Lion Global SGD Money Market Fund, the SGD Enhanced Liquidity Fund, and the Short Duration Bond Fund. Each of them make up roughly 1/3 of the portfolio. The Money Market Fund invests in high quality short-term money market instruments. So this is the most the most safe you can pretty much go when it comes to a bond fund. But then there's also a third, which is the Enhanced Liquidity Fund, which goes into mostly government bonds, like Singapore government and so on, issued bonds. The average weighted duration, meaning the time until these bonds mature, is about 12 months. And in order to achieve a slightly higher return, There's also a third allocated to the short duration bond fund. The average duration is still around only 2 years, and it invests into Singapore and international bonds, all hedged towards the Singapore dollar, so there is no foreign currency risk. And also all the underlying companies, there are investment grade companies, most of them actually state-owned enterprises. So how does how do we come up with this return? So the projected return of the mix of these three funds is about 1.8%. There's 35 basis points or 0.35% of fees which we have to pay to Lion Global, but 0.3% we are able to return as a rebate. Why are we able to do this? Because we are not charging any management fee on this portfolio. So the projected return is about 1.75% per annum. How does this compare to some of the other solutions? I think, as you can see here, the projected return is among the highest between our and similar other products. More importantly, or as important, there is also no deposit requirements. So there is no minimum of $10,000 like for some other products. And it also doesn't stop if you go above a certain amount, right? So there's some other products which you only give it to you for the first $20,000. So for Syfe Cash Plus, regardless if you invest 1 million or $1, you will always get basically the same return. Yeah, so that was a quick introduction about Syfe Cash Plus. I saw there was one question coming up. Hayden, should we answer this question immediately?
Sure, sir. So one of the question that came in is that currently does Syfe implement a live portfolio value reflection on the account, and is there any instant selling of these investments?
Okay, I think that's a very interesting question. So the answer is no, we are not showing live values, but we're updating them actually on a daily basis. I think the main reason for this is because unlike a brokerage platform, which is like for like daily trading and so on, we are not, our platform, our portfolios are geared towards long-term wealth generation. So these are not for traders or speculation who want to like quickly move in and out, but we are more like long-term wealth generation. So that's why we don't think that there's actually really a need to show the live value throughout the day. We will update once a day using the closing prices. So when the stock exchange closes, this is when we will do our trades, and this is also when because there we can get the most efficient pricing because the volume is the highest, and this is also the price which you will see updated on a daily basis on your dashboard. And when it comes to buying or selling, so if you deposit or withdraw funds, then basically this will happen usually on the same day. In some cases on the day after, if you are if you receive the instructions after the cutoff time. Hayden, can you remind me of what is the cutoff time?
Well, generally we will update this end of the day. So we have updated this to 2 times. One, it's around 7 p.m. for the Singapore market, and then 4:30 for the US market for the updates.
Yeah, 4:30 a.m.
Yes.
Just for people on 4:30 a.m. in the morning, we update for the US market because the US market closes around 4 a.m. in the morning. Yeah.
Right.
All right. I think there were some other questions on Cash Plus coming in.
Right. So I think this is an interesting one. So based on the comparison that we have, how come Syfe we are able to offer a slightly higher return? than some of the competitors out there?
Yeah, I think there's two reasons for that. One is that we are absolutely charging no management fee on Cash Plus. As you will see later on, we do charge on our other portfolios, and we are very transparent on this, but we don't charge it on Cash Plus because we consider it as something where people can really park their money, you know, when they you know, as the emergency fund, or if they want to invest it later on, and we basically are not charging for this. The other part is why we are able to offer higher returns is because of this short duration bond fund, which is part of the portfolio, and this has a slightly higher average maturity, which is about 2 years compared to 1 year on the enhanced liquidity fund. So this means there can be some slight volatility there, but at the same time, this will give us this extra amount of return. And I think this leads directly to the next question. I think there's some user asking, is there a risk of losing money when we invest in Cash Plus, right? So the answer is it's an investment. It's not a bank savings account. So there is some risk, but please note that the majority of it is invested in government bonds, Singapore government bonds. So in order to lose all your money, that would mean that the Singapore government would not be able to actually, you know, like basically it would mean that the Singapore government would default, right? So the risk of this happening is very, very small, and I believe then we have overall like very, very big problems, right? Singapore in the whole world is one of the highest rated, has one of the highest credit ratings in the world, right? Even for the short duration bond fund, these are only investment grade bonds, so of the highest grade. And even there, a lot of the companies are state-owned enterprises or quasi-state-owned enterprises. So the risk is extremely low.
All right. So Seb, maybe we can take on one more question for the Cash
Sure,
Plus
like
as well.
we can answer all of them.
All right, sure. So so far, has the Cash Plus managed to deliver 1.75% per annum since inception so far?
Yeah, that's actually a question which I always like to answer because actually the fact is that currently our annualized returns on the Cash Plus portfolio is actually about 2.4%. So it's actually significantly higher than the 1.75 which we projected, right? So especially January, February were extremely strong, and it has slowed down a little bit in the last 3 weeks or so. But our annualized returns, which we have achieved over the last few months, are significantly higher than what we actually promised.
Okay.
I think I see one more question regarding the liquidity, right?
Correct. So
where someone is, yeah.
Yeah. So in that sense, for the how do we actually guarantee the 100% liquidity when users want to withdraw from Cash Plus and maybe even for our other portfolios then?
Yeah. I think let me first answer this this question regarding Cash Plus specifically. As I mentioned, withdrawals and deposits are not instant. They take 1 to 2 days for a deposit and maximum of 2 to 3 days for a withdrawal, right? The reason for this is that actually the underlying bonds are actually bought and sold, right? And there is actually really these trades are really happening, right? So this is not we are not like just like like it's not Syfe who provides this liquidity or anything. It's really like the underlying bonds are sold on the market or bought on the market in case of a deposit, which will basically ensure that that there's liquidity. Also, how they are chosen, how they choose these bonds is, of course, one criteria is the liquidity of these bonds. So all of these are bonds which are extremely high volume on a daily basis. Otherwise, they would not make it part of this portfolio. Moving now on to some of the other Syfe portfolios, answering the same question about liquidity. One reason why we are trading actually, or we're using a lot of US listed ETFs is exactly liquidity. US listed ETFs are much more liquid than some of the equivalents traded on other stock exchanges in Europe or Asia, right? Because the volume and the daily trading volume is so much higher. So that's one of the reasons why we basically go for this option. I hope this answered the question. If not, please feel free to put it there one more time.
Yes, thank you, Seb. I think you answered all the questions that were pending for the Cash Plus.
Cool. All right, then let us move on to REIT Plus. As I mentioned earlier, the index is created by SGX, or more precisely the IH team, which is part of SGX. And the index tracks the largest and most liquid REITs listed on Singapore Exchange. So what we expect from this is both a capital appreciation, meaning the value of these REITs going up, as well as an attractive dividend yield. Here it says 5.1% for 2019. We have shared earlier that this rate was 4.5% in 2020. Historically, this is actually usually, like even higher than that. Like there's many years where you have seen dividends above the 6% rate. But with overall interest coming down, also dividend yields of REITs decreased a little bit. How do they choose them? So of course, there is one major factor is the market capitalization of the REITs, but then they're also screened for free float, for velocity, and there is a cap of 10% for each of the individual REITs in the portfolio. And you will see that this is currently not the case, but I will also explain why. So these are all factors which make sure that the quality of the REITs in their measured by really like quantitative technical facts is good. Yeah. Furthermore, they are using something called FactSet's RBIC classification in order to select the right 20 REITs out of the 44 which are listed on the Singapore Exchange. We do regular sessions with the IH team of SGX, and you should watch out for one of them, because there we go into much more detail on how these REITs are selected. One other news on regarding REITs is that SGX just announced their semi-annual rebalancing. So by tomorrow, also the REIT portfolio, the REIT Plus portfolio of Syfe will rebalance in order to be in line with the IH S-REIT Leaders Index. Yeah. What is the current constituents? As said, they will change tomorrow, and we will update it accordingly. Currently, there is 19.8% capital and integrated commercial trust, which breaches the 10% cap, right, which I just mentioned earlier. But the reason for this is that there's two capital and REITs which merged, right? And that's why they are basically double the maximum weightage, right? Maple Tree Commercial Trust is above 10%, but for a very different reason. The reason for them is that they grew stronger than some of the other REITs in the portfolio, which is why they are now making up for a bigger portion of the portfolio than they did when the last rebalancing happened. On the right side, I find this always quite impressive. This is some of the shopping malls and office towers which are owned by some of these REITs. I think we all know and we all frequent them quite often. There are two different options available for the REIT Plus portfolio. There's a 100% REIT portfolio, and there's a risk-managed REIT portfolio. The 100% REIT portfolio consists of only REITs, as the name suggests, and basically tracks exactly the S-REIT Leaders Index. The risk-managed REIT portfolio combines the REITs with Singapore government bonds. So depending on the risk, depending on the volatility, how much the market fluctuates, we blend the REITs with Singapore government bonds in order to defend against rising volatility or to make it more resilient towards volatility. And the more volatile the markets are, the higher the share of Singapore government bonds in the portfolio is. The maximum, though, is 50%. The government bond portion of the portfolio will never be above 50% of the portfolio. The REIT portfolio, the REIT portion of the portfolio is at least 50%, but it can be also 100% in very calm markets. This was a quick overview about the REIT Plus portfolio. Do we have any questions related to REITs, Hayden?
Right. Perhaps one question would be that considering last year, how were dividends being impacted, and was it a large impact?
Yeah. It's a good question. So as I shared earlier, the dividends have come down by 0.6 percentage points. So from 5.1% in 2019 to 4.5% in 2020. Nevertheless, I do think that this is still very, very attractive considering where interest rates overall are, right? There's one thing which really helps, one regulation which really helps these dividends and why they will, I think, stay very attractive is that REITs in Singapore are forced to distribute 90% of their profits as dividends. So part of the rules of being a REIT listed in Singapore is that you need to distribute 90% of your profits. So I think that's part of why their dividends are still so attractive and what makes this overall sector so attractive.
Right. And I think one more question would be that with the REITs market, we are still in the shadows of COVID. What's going to happen to office REITs and retail REITs moving forward? How do we view this?
Yeah, I think that is a fantastic question, right? And I think I want to answer this in two different ways. One is a pandemic shows how important it is to have a diversified portfolio. If you hold just one REIT, and the REIT is in a sector which is highly affected by a certain circumstance, then the impact can be very big. But in many cases, it will affect a certain sector, but maybe another sector will benefit from it. So to give an example, we all know that office REITs and so on were highly affected last year, but some of the logistic REITs, some of them who benefit from an increase in e-commerce, REITs which have warehouses as part of their portfolio and so on, they actually benefited from it. So if you hold a diversified portfolio, you will always have a more resilient portfolio because sometimes they will balance each other out, right? But the other part is that with REITs is that it's a physical good, and it's a limited good, especially in a city-state like Singapore, which is which is a relatively small island, and therefore like we cannot just build new properties on however much we want. We are limited by the space we have. So even though I doubt that it's true that work from home will mean that there's a significant reduction in office space, but even if this would be the case, then people would reuse this space to do something else. I'll give you an example. People work more from home, meaning maybe less office space required, but people looking for bigger apartments. Why? Because they spend so much more time at home. They need an extra room which they can turn into their kind of office, because their kids are running around and they need a quiet space to work. So suddenly, actually, the space requirements for residential will go up. So, and they will always find ways to repurpose certain buildings in order to account for that.
Right. Thank you, Seb. I think we've answered most of the questions on the REITs. We can look at the equity 100 then.
Okay. Cool. If there's any other like REIT questions, we'll come back to them. We'll come back to them later. Let's jump into the Syfe Equity 100 portfolio. Just as a quick reminder, it's 100% equities portfolio, as the name already suggests. There are a lot of, like, most of these companies you would actually know, and you can see some of the logos on the right side. We use a smart beta strategy in order to achieve higher risk-adjusted returns compared to a regular like market capitalization, a weighting up by market capitalization. And the smart beta strategy means we tilt towards certain factors, and the factor could be small companies over large companies, or in our portfolio is actually the opposite. We tilt towards larger companies over smaller companies. We tilt towards lower volatility over higher volatility, and we tilt towards growth stock rather than value stock, even though this is currently slightly reversing, and we are accounting for this in our rebalancing. The important part that this is something still like very quantitative. So this is not the opinion of a fund manager who just like decides based on his or her opinion, but this is something which is highly quantitative, meaning like there's numbers. This is a numbers-based strategy, which is purely influenced by how do certain technical indicators change over time. The first point I already mentioned. So it's rules-based, it's quantitative. It's happened through selection and rebalancing. So we rebalance this portfolio twice a year. And the factor considerations, as I mentioned, is growth, volatility, and size, right? So I already mentioned all three of them. So in terms of, growth means versus value, volatility means low volatility versus higher volatility, and in terms of size, we go for large rather than small cap. At the bottom, you can see what this means for the portfolio. Roughly in terms of sector weightings, as you can see, there's a lot of different sectors. Is a highly diversified portfolio again, including a lot of information technology, consumer staples, as well as discretionary, communication services, and so on, but also utilities, financials, and energy. I want to use this also to show an example on how we decide between US listed ETFs and so-called UCITS, so Ireland domiciled ETFs, because this is one of the questions we get in almost every webinar. And we have here two examples. The S&P 500, we have the option between, for example, the SPY, a US listed ETF, and CSPX, which are both tracking the S&P 500. We have decided to go with SPX because the withholding tax of a UCITS ETF is only 15% versus 30% of a US listed ETF. But in the case of Nasdaq 100, where we have also the choice between a UCITS and a US listed ETF, namely the QQQ and the EQQQ respectively, we have decided we go with the US listed ETF. The withholding tax is 30% rather than 15%. But the management fees are lower for the US listed ETF. So this 15% in different withholding tax, and withholding tax only applies to dividends. So this is also an important part. Yeah, makes only 0.03% of difference. So the UCITS ETF pays 0.03 percentage points higher dividend than the US listed equivalent. But the management fees are 0.1% higher, which is why it's still beneficial to go with the US listed ETF rather than the UCITS. The other considerations, and this is just mentioned in one sentence below, US listed ETFs often have lower spreads and higher liquidity than the UCITS counterpart, something which I think already mentioned earlier when we were talking about liquidity. So this was an introduction about the Syfe Equity 100 portfolio. Let us answer some of the Equity 100 related questions.
Right. So, Seb, for the Equity 100, will Syfe be looking at including more China ETFs? And if so, when are we looking at doing this?
Yeah, I think that's a fantastic question again, and something which is coming up soon. As you know, that Syfe Core already includes exposure to China, and Equity 100 will follow suit soon. I expect it to happen with the regular semi-annual rebalance early April. So it's only about 2 to 3 weeks away.
Right. Thank you, Seb. And also, in terms of thematic ETFs or maybe even ESG ETFs, will we be looking at including them at the moment?
Yeah. I think we have some themes, right? We have REIT Plus is clearly a thematic ETF. We have, like a strong exposure to tech stocks through our Equity 100, through our Equity 100 product. We currently don't consider an ESG portfolio. Frankly, like I don't like. There's definitely a market for it, but I think we are focusing, rather than offering every single product which is available, but we are trying to focus on offering the right product for different use cases or for different objectives. And I think so that we have like this set of 4 portfolios, which I feel serves most of the different objectives.
Right. Thank you, Seb. And one more question. For Equity 100, the dividends after the withholding taxes, are they being reinvested or are they being distributed?
Yes. So all our portfolios automatically reinvest dividends, which will actually help to get an even higher return because it helps with compounding. On the REIT Plus portfolio, there the user has, the investor, the client has the choice between a payout option or reinvestment. If the user chooses to get the payouts, users will get a quarterly transfer directly to their bank account.
Thank you, Seb. I think those are the pending questions. I think we can also touch on the Syfe core already.
Great. So Syfe core portfolios, 3-4 key highlights is a very stable asset allocation. So yes, it does change over time, of course, and we do rebalance it twice a year. But in the moment when you decide that you go with a specific core portfolio, you will know that this has a relatively stable asset allocation. So it's ideal if you want to DCA into a portfolio and you want to make sure that you don't DCA and then suddenly it's rebalanced to something else. It has an increased China focus. So I think there is a big consensus that China will be one of the driving forces in the 21st century. And I think our stock portfolios should account for that. So that's why we have increased the exposure to China. And on the right side, if you look at some of the names, you will immediately see that. As I already mentioned, because of the stable asset allocation, it is ideal for dollar cost averaging. So this is probably the easiest way you can actually implement a passive investment strategy, which is at the same time very sophisticated. And what we work on is basically we want to maximize long-term returns, right? And how have we done this is that the equity portion of the portfolio is similar to the equity 100 portfolio. So equity 100 does not yet have the China exposure, but it will get it, as I mentioned earlier. But it uses the same investment strategy, which has yielded so fantastic returns last year. Quick overview about what is in the portfolio. Equities, which equities, at least in the balanced as well as the growth portfolio, the biggest portion of the portfolio. It has global market exposure, meaning the US with S&P 500, MSCI EAFE, which means the developed markets, Europe, Japan, Korea, and so on, as well as emerging markets. Right? So this would be, like China, Brazil, India, Indonesia, Thailand, and so on. But we feel that China is still a too small part of the emerging markets. And we feel that this is something which we quantitatively show. So which is why we have 2 ETFs specifically covering China. So this is the MSCI China, which is a very broad ETF covering all kinds of industries, as well as the CraneShares CSI China Internet ETF. So this focuses on Chinese technology companies. And then we have the smart beta, the ETFs which we use to implement the smart beta strategy, right? So QQQ, which helps us to get exposure to both technology companies as well as large cap companies. We have the mid and small cap if we want to tilt towards this. And then we have certain sector ETFs, which can give us exposure to specific sectors which we want to have in the portfolio, right? And this is in order to achieve the low volatility and similar things. Then we have bonds in the portfolio, a mix of US as well as international bonds. And an important part, especially when it comes to inflation hedge is gold. So we have the Spider Gold Shares ETF in the portfolio. As I mentioned, core is not one portfolio, it's actually 3 different portfolios. And depending on your objectives and your risk appetite, you can choose between the defensive portfolio, a balanced, and a growth portfolio. The defensive portfolio has 70% exposure to bonds, only about 21% equities and 9% gold. While the growth portfolio has more than 71% equities, 23% gold, 23% bonds, and 5% gold. What does this mean? That means that the returns, especially when you look at them over a longer period of time, will be higher for the growth portfolio than the defensive portfolio. But it will also mean that the risk measured by a standard deviation, for example, a max drawdown, will be much lower for a defensive portfolio than for a growth portfolio. I'll just give you, like one example. If you look at the last 5-year return of the defensive portfolio, it's 6.8%. And the worst drawdown over the whole period was 5.8%. So from the highest point to the largest drop would be 5.8%. While for the growth portfolio, yes, last 5 years, the annualized return would be 12%, but the highest drawdown would also be about 11.6%. So if you are an investor who can stomach a little bit more volatility, you will get better returns with the growth portfolio. But if you're a bit more sensitive and you're a bit more anxious, maybe when there's small market correction, then the defensive portfolio will help you to achieve good returns with a much smaller drawdown. I think one other important consideration is, what is your investment horizon? The longer your investment horizon, the more risk you're able to take, because in case there are drawdowns, you'll be able to actually ride them out and just wait until it has recovered. If you're having a very short time horizon, then it's better to go with something a little bit more conservative. So much about the core portfolios. Do you have any questions for me?
Yes, sir. So basically for the defensive, balance, and growth, does the composition in these portfolios actually change over time?
Yes, there might be changes over time, but it will be relatively stable, especially when it comes to the allocation between the different asset classes, meaning like equities, bonds, and gold. We'll rebalance it twice a year in order to make sure that especially the equities component has the best possible asset allocation. So it has the right, we use the smart beta strategy, right? So we have the right factor tilt. So we focus on the right kind of sectors and so on.
Right. And probably one question on some of the fees, which we might be touching on a bit later, but perhaps we could address this first. For Syfe Core, there will be it's considered a fund of funds. So with the underlying expense ratios in these ETFs, does this mean that users are actually paying more for the fund management fee here at Syfe? And how does this actually work for them?
Yeah, I think also a great question. So it's not a fund of funds. Each investor holds units in the underlyings directly through Syfe. So Syfe itself, while we are a fund management company, we are not it's not a fund you're investing in. You hold directly units of these underlying ETFs. One of the reasons why we use ETFs is they have a massive advantage over unit trusts, that they are so much more cost efficient, right? And I'll give an example. If you invest $20,000 with Syfe, the management fee will be 0.5%, and the fees of the ETFs will be maybe about 0.15%. So the total will be about 0.65%. While the average unit trust in Singapore will charge anywhere between 1.5% to 2% per annum, and in many cases you will you'll also pay entry or exit charges, and even charges when you're switching fees and all these kind of things. So I think it's a very cost efficient solution which we are offering. We come to some of the pricing and what it includes in a bit.
Right. And probably one more question. Between the Syfe core growth and the equity 100 that we've talked about earlier, what are the factors should an investor consider when deciding between the two?
Yeah, I think that there's two main factors. One is the time horizon of your investment. If you are investing for 2 years, 3 years, let's say a relatively short period of time, you probably should go more with a bit something more like a defensive portfolio, right? If you are 40 years old and you invest for your retirement in 20 years from now, you can take more risk, right? And maybe an equity 100 or a core growth would be the right portfolio. And the other part is then your risk tolerance, right? Does it, no one is happy about, if the portfolio goes down 15 or 20%. I understand no one will like it, but some people will really panic and immediately sell. While if you would just hold on to it, you would actually be able to ride out the wave and you will benefit from it later on, right? And maybe you buy even more when such a drop happens, right? Between equity 100 and core growth, right? So this is just like, you can almost look at it in 4 different risk levels, right? Defensive, balanced, growth, and then equity 100. So equity 100, historically, it will have given you the highest return, and probably also in the future you will be able to see the highest returns, but the volatility will also be the highest. Yeah.
Right. Thank you, Seb. So I think we can move on to the next how to start section.
Great. Sure. How does it work? Basically, as the first step, you simply go to our website where you find a lot of information about all these portfolios, and you sign up there, or you download directly our app in the App Store on Google Play. And the first step will be you will go through a short questionnaire, which will give you a portfolio recommendation. In the second step, before you invest any funds, you'll be able to see every single detail about the portfolio, the underlying, the historical returns, and you also have a forecasting tool where you can see how much is realistic, like what you can expect over the next 5, 10, 15 years. And only then you basically decide, do you want to invest or not? And once you have basically invested, you'll be able to see the portfolio or monitor the portfolio on a daily basis. Monitor the portfolio on a daily basis, and you, as we explained earlier, like basically you will be able to see your updated portfolio value every day. We offer very low fees, depending on how much you invest with us. For investors who invest anywhere between $1,000 and $20,000, so there's absolutely no minimum investment amount, the management fee is 0.65% per annum, which equals about $1.20 if you invest $10,000. on a weekly basis. Above $20,000, we reduce the management fee to 0.5% per annum, which equals $100 a year, less than $10 a month. And you get access to wealth experts such as Hayden, who can discuss with you your individual situation and give you more details about our different portfolios. Above $100,000, we reduce the fee further to 0.4%, and above $500,000, we do some more customized solutions. Cash Plus, we are not charging any management fee, but the Cash Plus account balance is also not included in your overall AUM or in your overall invested amount when it comes to calculating your Syfe pricing tier. This pricing is an all-inclusive pricing. It includes all trading fees. There are no entry-exit charges. There's no minimum balance. You can invest as little as $1. There's unlimited free withdrawals. There's unlimited rebalancing. So we were talking quite a bit about rebalancing, right? Whenever we decide to rebalance the portfolio, there's no charges for you. Or now when the REIT Plus portfolio is rebalanced because of the index change, well, there's no cost for you. And one of the criteria, not the only one, but one of the criteria how we choose ETFs is low management fees in order to keep the overall cost of the portfolio low. A quick comparison of Syfe versus do-it-yourself investments. So there's no minimum investment amount with Syfe. If you're a DIY investor, you're subject to minimum lot sizes. You need to buy at least one unit, and so on. You don't require a CDB or brokerage account with Syfe, which also means that you can get an account with as little as 3 minutes using my info. While with many brokerage accounts, it still takes multiple days. We offer advanced risk management, optional in certain portfolios. We automatically rebalance and re-optimize the portfolio. There is automatic dividend reinvesting. Actually, like for the REIT Plus portfolio, we calculated that by automatically reinvesting dividends, you can make 0.5% in additional returns on a yearly basis, which is basically already as much as the management fee Syfe charges. There are no brokerage fees, and there are low management fees starting from 0.4% per annum, which is in both cases much lower than what brokerages would charge, or unit trusts would charge as a management fee. One of the thing, in my opinion, best features is, yes, we are a digital wealth manager, but you still have access to humans, and this is our wealth expert team, and they can really help you if you have questions about your individual's situation, or if you have more detailed questions on some of the portfolios. And regardless of how much you invest in the first month, you'll have free access to them. On an ongoing basis, access is limited to clients above $20,000. What are the upcoming webinars? As mentioned earlier, next week we have a deep dive into our investment strategy with Richard Ye. I think this will be a very interesting one. But then also the week after, we have a REIT-specific webinar together with Dhruv, our founder and CEO, always on Thursdays at 7 p.m. Last but not least, before we answer the rest of the questions, we offer a 6 months fee waiver by answering just a few very quick questions. So scan the QR code, answer 2 or 3 questions. At the end, you will get a promo code which will give you 6 months fee waiver. Hayden, what questions do we have?
Right. So I think this is one of our most favorite questions as well. So, with so many competition in the market right now, how do we, differ from the other competitors within the market?
A good question, which we also receive, which we receive frequently. I think it's actually a question which was asked about like half an hour ago. I wonder if the person would have still the same question after seeing some of the things which we have shown, since then. But I think I think there's a lot, right? I think on one hand, the portfolios, right? I think the REIT Plus portfolio is something which is absolutely unique to Syfe. But also when we look at Cash Plus, right? In terms of the projected returns you can achieve there, but also a lot about the other features like how fast it is to deposit, how fast it is to withdraw, the fees we are charging, and so on. I think it's also I think one other important part is I think we also have attracted a very significant amount of funding. We raised 25 million Singapore dollars in September of last year, which basically allows us to further grow our business for the foreseeable future. And it also this funding came from very reputable investors, which which should give people confidence that they're investing with a good company. I think a question which I saw coming up twice, and now April, I just asked. I missed half of the Zoom session. Is it possible to watch the session again? Yes. It will be published on our YouTube channel sometime tomorrow, probably more towards the end of the day, and you can watch this session. I think from sometime tomorrow afternoon. But you can also watch some of the previous sessions, and all of our webinars are available on our YouTube channel.
Right. And I think one more question we can address, Seb, would be that with interest rates so low now, and moving forward, we definitely will see that interest rates may slowly climb back up. How does this actually impact growth portfolios like the core and maybe the equity 100?
I think it's a very interesting question. I think how I would answer this question is the following, right? Interest rates will only go up if the economy does well. I think the central banks, regardless where in the world they are committed to support the economy, not only now where there was a pandemic, but throughout the next months and years. And that means interest rates will only increase if the economy does well. So while theoretically an increasing interest rates will mean that the price of equities will come down, I don't think this will really happen because interest rates will only go up if the economy does well. So I think I'm not too concerned about this, but it is interest rates are definitely a very relevant thing which we are watching on a daily basis.
Thanks, Seb. I think that's all the questions that we have tonight.
Okay, fantastic. Then I appreciate everyone taking more than an hour on a Thursday evening to join us for this session today. Great. Again, thank you for joining, and Hayden, thanks for hosting us tonight.
Thank you, Seb, and thank you, everyone.